Okay, so a warm welcome to everyone. Thank you for joining in today. And this is going to be a very special webinar. For a lot of people, it is going to be like an eye opener, something they're understanding, getting a peek into for the first time. Okay. A lot of people over here are pretty new to the subject, less acquainted with the subject of how quantitative methods are used in finance, how algorithmic trading is done, and wherein a lot of popularity has come around the stock market in the last couple of years. People who are educated in finance or are students of finance or are traders themselves from a considerable period of time, they have begun to inculcate the curiosity around the topic of algorithmic trading. Is a lot of people who are finance professionals, okay, they are looking forward to probably take more learning and jobs in algorithmic trading. There are a lot of HFT firms which have opened up. So over the years, there's been a lot of development. And in the last 4 or 5 years, there's been some really high scale development when as far as this industry is concerned and the exposure in India is concerned. Okay, so if you know a considerable amount of things already, okay, you will still take away a lot of things. There will be a lot of clarity of thought on the basics, and who don't know at all will definitely take a lot of value from this. So please listen carefully. So our focus is on an introduction to quantitative finance, okay, and to algorithmic trading. Now, a lot of terms are used here. First of all, a lot of terms are used here. कोई algorithmic trading बोलता है, कोई quantitative finance बोलता है, कोई HFT बोलता है, कोई MFT बोलता है. So what does all this mean? Let's understand. So under the larger, broader set of things, a subset of quantitative finance is algorithmic trading. Now, algorithmic trading being a subset and being an area of our interest is going to be our central focus. Well, let's just understand what quantitative finance is. Broadly speaking, quantitative finance goes all the way back to, you have people who have done even CFA level 1 or level 1 and level 2 or have done an MBA may have heard of this. Portfolio selection theory by Harry Markowitz. So because it uses statistics, mean, median, mode is something very basic, class 8, 9, 6, 7 statistics we have learned. That graduates to become covariances and co-integration and things like that, beta, alpha, things like that. So a lot of, a lot of statistical models are used, and that started happening way back. So even that comes under quantitative finance. The Black-Scholes model for option pricing, even that comes under quantitative finance. After all, it's a differential equation. So a lot of mathiness is there. A lot of statistics and maths is used. And even today, quantitative finance has not just, it is not just consumed within stats and math. There's a lot of computation which is there. And because there are a lot of open source tools available, we will discuss that. We'll discuss examples. There are a lot of open source tools available. What tends to happen is that even very new things have come under quantitative finance. I'll just give an example that there could be a hedge fund taking data right after a news is released and has a robot scrapping the web for immediate data to get an edge over and above other fund managers and other traders. There could be data which could be coming through satellites, and say, for example, there is Walmart and there is a parking, the parking lot outside Walmart, and such many Walmart stores and the parking lots outside them. What is the flow of the cars going in and cars coming out. Even that could be used to predict what the quarterly sales are going to look like or the monthly sales are going to look like. So there's so many new things happening under the umbrella of quantitative finance, and there's a lot of innovation which is happening, and there's a lot of things. After a point when you come to having a lot of knowledge about all these things, you could innovate. That's the best part. And because you will innovate, you will find something called an edge. And there are robust ways of testing that edge, which is called back testing. And then there's something called optimization. So all of that is something we're going to go through. Okay. I hope you all are with me till now. Whatever I have said makes sense, right? Or you want me to be more basic, etc. Okay. It makes sense. Just give me a yes or a raise of hands, right? So quantitative finance is the broader umbrella. We could have models coming out, which would be investment models on the basis of which there could be long-term investment done. And if the back testing results happen to beat the broader market or a relevant benchmark, we'll talk about benchmark also. That could be an investment model. There could be trading models also, which could range all the way from scalping or something which is some other trade strategy which may be risky, or something which is as good as arbitrage and very, very safe. Okay. So there is a very, very wide array of things we're going to discuss. So our agenda is to first have an idea about the background of quantitative finance. Okay. Then let's just understand what we know till now. Okay. Assuming that you are very new to quantitative finance, or you may have not seen applications of quantitative finance, because all over the news, what you tend to see is subjective opinion, right? Or if you read a research report on a company, or say, for example, a small cap stock, and you're researching that small cap stock to see if that could be a nice multi-bagger investment idea, there are a lot of things which you are actually reading is qualitative. A few things may be quantitative. Yes, there are, investment models which are trying to find the intrinsic value of a stock. But then there's always this assumption that this is going to be the growth rate. Therefore, the company is going to grow. Those are projections and assumptions. So a lot of things are there in quantitative finance that tend to make even these projections and assumptions through machine learning, through coding. Now, when those projections and assumptions are done by a human being, there is a human bias. But if the same projection is done by a machine, it is far more objective, and there's a range of probabilities, okay, which is thrown in front of you. So there is a lot of computation over there. We'll understand the difference between qualitative and quantitative analysis. And there will be a small discussion. I'm not going to go too deep into that scope of financial mathematics used. Okay, so there'll be a small discussion on that. I'll give you an example of a trading strategy, of two types of trading strategy actually. And I'll also show how they are coded, right, on Python basically. And we'll discuss about the computing methods, etc. There's a lot which is available. Impossible to show it in a small webinar. But yes, giving you a few examples would make sense. And after that, after the different types of algorithmic trading strategies, which we'll discuss, then we will discuss what are the logical steps. Okay, now the logical steps to creating a trading system is something which is going to go ongoing parallelly to each of the discussions, because as I'm going to speak about the subject, one of the primary things which is going to anyway run in your mind is what is the next step I should take if I want to build something of my own, if I want to innovate, if I want to learn about this, or what are the tools which I need, where am I lacking, what are my weaknesses, where do I need to improve, what is it that I need to learn, right? So there's a whole host of things, flurry of information and knowledge which is coming in front of you, right? So if at all, if somebody is going to per se speak about algorithmic trading, right, they're going to talk about the different aspects which are required, right? The first is the background understanding, as I said, like how it is very, very different from a qualitative, how it is different from a qualitative approach, right? So the major difference is, and herein you will understand what are the advantages as well as there are some disadvantages also. Okay, there are some disadvantages also. So for example, if you are a trader and you want to create an algorithmic strategy, it will trade on its own. So yes, even when you're sleeping and there's a market in another country, in another time zone, which is going on, and it is live, and your strategy is live, and there is a trade signal, and the trade is taken automatically, the trade is even squared off automatically, all that is fine. But to be able to build a trading system, to be able to create and innovate, what you have to do is essentially qualitative research. So when I'm coding strategies, when I'm doing even some pen and paper work, trying to find what are the important aspects for my edge in a particular kind of strategy, where do those observations come from? They come from exploring new concepts or exploring the concepts I know in a more qualitative way, in a more observant way. So there's a lot of observation involved. There is this observation, not with just one factor. Say, for example, I look at a trend following strategy and I give a lot of weightage to a 20-period moving average. A simple thing which I think everybody can understand, right? Over here, I say 20-period moving average, and this will be one of my important components of a strategy. Now, we all know it doesn't work like that, right? It won't give me the ultimate results. But I could use other variables and other factors and other statistical concepts, other technical analysis indicators, other market variables. And these relationships which I observe is going to be a very subjective thing. So you need to be first in any IT field, okay, any other company also creating some sort of a product or a software or something which is an IT-based product, right, a tech-based product. They always have somebody called a subject matter expert, right? So you need to be first, to some degree, you need to be a subject matter expert. I'm not asking you to write a book on investing. I'm not asking you to sort of have every opinion about every company in the world, every economy in the world. But I'm saying to a certain extent, to whatever you can and to whatever your interest allows, you will need those inputs through qualitative research, right? So that is something which you cannot rule out, but you have to segregate what you're doing, when you're doing, and do that when you're doing, right? So qualitative research seeks to understand things more deeply. They understand even the exceptions and the nuances. For example, there's something very simple if I have to give you, that there is a particular event that could be the presidential elections or the prime minister elections or something which is a cyclical event, etc. Okay. So a regular trader would say, okay, fine, I know there is the event and I have certain strategies in place, but I think I will cut down my leverage. I will cut down my leverage because there could be something very erratic happening in this event and my strategy is not going to take that well. So I'll cut down my size. So that is a subjective decision which is being made over there. Because the trader understands that this is an exceptional day and there would be exceptions over the price movement and price action happening today compared to a lot of other days. Okay. Something not normal, something that could be extreme. So that's a nuance, that's an exception. Like that, a machine needs to be trained. So a machine doesn't know, which country has got which sort of elections going on, or whether should I support Congress or BJP. Machine doesn't know that. It just gives you whatever data you feed, whatever the training you give it, it replicates and loops in the data and looks through the eyes of the lenses you have given the machine, right? So all those nuances need to be quantified. Now that is a challenge because if you see there are many hedge funds which completely vanished after certain major market crisis. so that something like that does not happen to your account or your client's account or the firm which you're working with, that account. You need to also account for those extremities. And that those are subtle important things about backtesting, which normally people don't conceive when they think about algorithmic trading. They tend to think, okay, I have an edge, I have an idea, I know certain things about the market, I know some technical analysis parameters, let me make a strategy. So it doesn't end there, it does start there, it doesn't end there. There's a lot of optimization needed to be done, a lot of backtesting needed to be done, right? On the other hand, quantitative, everything, the approach is to quantify. Whatever I have, I want to quantify. I mean, sometimes it's like my mind starts working in certain ways that when I'm looking to quantify everything, while coming back from the gym, I'm thinking, okay, what is the probability that my wife has made this for breakfast today? Okay, something like that. So, you tend to quantify everything when it comes to the data from market variables also. It's highly data driven. So when I say data, how wide can it be? When I say data driven, how wide can it be? Of course, it can be super wide, right? Like if you go to HFT firms, they are going to have data. Okay, a regular trader, वो क्या सोच सकते हैं? How much data is going to be there? What is the depth or what is the width of data which is going to be there? 1 minute chart, if you ask, so okay, somebody will say, no, there could be a tick chart that every trade which is happening, there could be a tick chart like that. But in actuality, if we are looking at just price data I'm talking about, that data could be about every change in the buyer and seller, in the bid and ask. A small change, even that is in the tick data. So high frequency trading takes in that data, which means like you can see, big size of data. And to be able to do that, a lot of computing power to process and clean the data and work with that data. So it's so highly data driven. And even if you're not an HFT trader, if you are a medium frequency trader, okay, then you still need data, right? Like if I have to make a strategy which will work on hourly charts, take at least a few years or 5-10 years of hourly chart data, right? Next is validating. Okay, so quantitative research helps you to validate everything. This validation is something very important because human biases tend to be there. Say, for example, there is a phenomenon in the market or an anomaly in the market, which I have seen during my college years and it has worked so well. And actually, I'm talking about something which I have seen, right? I'm not going to details of the phenomenon or the anomaly, but I observed something in my college days, and 3, 4, 5 years, I was like, wow. And later I started trading it also. And I still see that happen sometimes in the market. Seems like a very obvious trade out there. But if I actually were to quantify it, if it had an 80% probability of success back then, it has a 60% probability of success now. So if I am able to quantify what is the probability or how it has worked over a period of, say every 6-month period from 10, 11 years, 11, 12 years back, okay, then I will see that there is a change. So my old bias, which as a college student, as a newbie trader, and as a very excited, enthusiastic trader, which does, that bias is something I've been trading with that has made me money, and I'm still doing that. But I need to find other avenues, right? Right? Whoever enabled closed captioning, I would say turn it off because it might come up in the recording. So, kindly just turn it off. Okay. Next is making decisions. So not just, validation and making decisions both go hand in hand because that removes the human bias. So within the umbrella of algorithmic trading, if I speak, making decision is something which the model does, right? Making decision is something which the model does. So we'll have to be very, very objective when we make decisions in the market. And what tends to also happen is that there is a limitation, also psychological. So if I give any of you unlimited amount of capital, I say you trade with one lot in futures, you'll probably do that very, very well. Then you say, no, raise capital. I want to raise more capital, give me more capital. I say, okay, fine, take more capital. Regardless of how much capital you have, there would be some psychological bias when you hit 20 lots or 50 lots, 100 lots. There'll be, and that will, create a big difference in your performance. So when you're making decision, you want to be as objective as possible. Quantitative research and quantitative finance gives you that bandwidth to scale. Okay, gives you that bandwidth to scale, right? So that is something which is again an important thing. Now, what do I need if I want to be able to shine at making trade strategies? If I want to be able to shine at quantitative finance, what do I need? Okay, this is one of the primary questions everybody has in mind, right? Okay, till now everybody with me? All good, right? If you have any questions, you can ask. Okay, right. So quantitative finance, man, the most important thing I need is the domain knowledge. You could be a very good coder. A lot of people have great coding skills. Okay, almost every day or every alternate day, there would be somebody messaging me on LinkedIn who is from one of the IITs, and they say, I want to crack into understanding more or getting a job in quantitative finance or algorithmic trading. And I'm a bit surprised because before asking me this question, when I asked them back, okay, what do you know till now? What have you explored till now? A very basic reply, first reply. They tend to say that talk nothing about the stock market, nothing about the financial markets or the economic environment. So please understand and make it very simply clear to you. This is not an opinion of mine. This is a fact. Great coding skills alone will not help. Okay. Great coding skills alone will not help. The first thing which you need is to have knowledge about the domain. And yes, with time, there are more and more and more resources, freely open source resources available to get more knowledge, to get not just more knowledge, get more data, more updation, real time. And then, you could just keep going deeper and deeper. Then you could choose your battles, as I would like to put it. There would be somebody who is a great analyst, but doesn't want to do anything related to the stock market. However, he or she wants to probably work trying to evaluate which startup is good to invest in. Okay. That could be domain knowledge for somebody. And yes, there could be application. There is quantitative finance application in that, starting from financial modeling on Excel and all the way. So that could be domain knowledge for you. However, if you're talking specifically about trading, then yes, of course, from the basic knowledge of the stock market all the way to, say, for example, somebody wants to create an algo which would be beating the market year on year, but it is an investment model. So in that case, the domain knowledge in which they will have to go in depth will be econometrics. A lot of data which shows the health of the economy and how the, say, for example, if I look at the trend of the GDP, a basic economic data, right? So currency, interest rates, GDP, a lot of these economic variables will be helpful for the investment model. If I want to make a medium frequency trading algorithm, what I need is the knowledge of my basic knowledge of the stock market, and then a good knowledge of technical analysis would help. An idea of price movement will help, so I can make my own indicators by coding. So these are the interesting things which I can do, right? If I am a high frequency trader, then I'll probably need more of statistics and mathematics. Slightly lesser market knowledge will do, but I'll need a very high level of statistics and mathematics and programming and the system architecture behind the programming. So for each of these different roles or the domains which attract you, please understand the requirements are similar, but they're not the same, right? They're similar, but not the same. Sorry, by mistake, I went to the previous slide. Okay, so the domain knowledge we've spoken about. Next is statistics and mathematics. So when I say statistics, when words like stochastic calculus, statistical concepts, etc., are used, one tends to get a little scared. So let me just put it to you this way. And it was for me too a whole very refreshing application of mathematics, which I found so real and so amazing. So before getting more quantitative, the last relationship I had with probability was way back in CFA, which was limited to sums and a few questions on quantitative finance subject and level 1, level 2, etc. But then when you are actually looking at probability and the different approaches which you can take, you can go very, very deep. Now, the thing is, when you have a strategy, you start with the domain knowledge, you start with an edge, and then you want to compute it. Within the computation, a part of it is coding the strategy. Okay, we'll see an example also later. Another part is not just coding the strategy, it is back testing and optimizing. So what is like back testing? Okay, when suppose I went to a store and I say I want to buy a new jacket. Since it's winter, I'll take an example of a jacket. And it doesn't fit me, or I don't like the color, or I don't like the, I need something warmer, for example. So I will go and look for another one. But say, for example, it doesn't fit me, I'll look for another size, right? So just like that, if you know, okay, I like this jacket or I like this strategy, I want to go and code it and back test it. But somehow it doesn't fit, in the sense, it doesn't give me any alpha. We'll discuss what alpha is. It doesn't help. So if I optimize it a little bit, even changing a stop loss could make a lot of difference in the performance of the strategy and the back tested results. Okay, so that is where there is heavy use of mathematics and statistics, because without the stats, how will I know the performance? Right. Now, when it comes to HFT, there is a lot of application of statistics from before. Okay, from the idea generation point only. Also, when it comes to econometrics and investment models, there is a lot of statistics in the beginning itself. Okay, so again, different pathways for different types of end products. Lastly, programming skills. No, even though I've kept it in the end, all these three are equally important. So programming is a skill. Now, when you say programming, people how many of you are acquainted with programming or know a little bit of programming over here? Can I have a raise of hands? How many of you have a basic idea of programming? Basic, आप कुछ छोटी मोटी चीजें कोड कर सकते हो, little bit, right? No problem. Some people may have more, some people may be actually from BTech background and may have gotten deeper. Some people are from the finance profession, so yeah. Okay, perfect. Thank you. Thank you for replying and interacting. Thank you. So, okay, yeah, perfect. So what I'm trying to say is coding is like a skill. And as a trading coach, as a teacher for a very long time, I love to give some real world examples. So let's say, for example, there's a guitarist. Just like that, there's a coder. Now, when you learn guitar, when the guitarist learned guitar, it was on a very basic, classical, a nice woody, old school looking guitar, right? And then after learning more, he or she explored, right, more things, and then even graduated to electric guitar. The understanding of the music is same. One of the instrument could be a little more difficult to play in a certain setting. One of the instrument could be easier to play in a certain setting. Just like that, when you come to programming, there are many languages available. Okay. So I can speak in English, I can speak in Hindi, I can speak a little bit in Bengali too. But my Bengali is not that fluent. Okay. Likewise, I can be having good language skills would mean knowing more and more languages and speaking each one very fluently. Like that, programming also is the same. And if I'm in India, being able to speak Hindi everywhere works. If I want to go and say, for example, buy something from the market, it works to speak in Hindi, right? Just like that. Say, for example, I'm outside India in another country where nobody knows Hindi, it will not make any sense. Likewise, there are a lot of programming languages, and we have to see what is fit for what. So if I'm going to make a website, I need to know how to code in Java. Or one of the, obviously I can code in other languages also, but like that is one of the more popular coding languages for making a website. All right. Likewise, for quantitative finance, for algorithmic trading, the popular languages are Python and R. And then, of course, C++ is there. Now we come to that discussion separately. So these different languages exist, and having a good skill of coding means either knowing one language very, very well, and then, because that is what you need. If I'm living in India, I need Hindi, right? So if I'm taking my ideas up for only MFT strategies, probably I'm done with knowing Python, and that is enough. But suppose I'm working with a firm and they use R and they use the environment which may be similar, but they use R, then I need to learn R. Or if there's a proprietary trading strategy which they already have and that needs improvement, then learn some other language also, right? So that is how it goes. But coding is a skill and it takes time, it takes practice, but one tends to acquire the skill. Now within coding also, there are a lot of things which you can code. So you don't have to go and learn how to code a website, right? You know what you have to do. So you are already within the niche. You want to take up coding after a bit of the basics, right? Then you need to start working with a lot of data sets which will be pertaining to your requirement in this domain. Right? After a few basics, you could use other examples outside this domain for those basic learnings, right? That is how it is. So these are the three things which you require, three pillars, so to speak. Understood, everybody? With me on, all of you are with me on this, right? Cool. Make sense? Any questions? Okay, I'm opening the chat. In case any questions, you can ask. Perfect. Everybody is understanding. Right. Now, on the face of it, this is how it looks like. That is, now we're getting more into the trading bit. We are not just looking at, let me just give you an overview of, 1 second. Sorry. Just 1 second, please. So let me just give you an overview and then we will dive into the process of how to build a strategy. So the one question which is there, what kind of quant profession do I want to take up? Or what kind of a role I would be called that I'm in this role if I'm working on these things. So of course, if you're an independent trader or you have your own algorithmic trading desk, you could trade with your own money. You could use those algorithms to trade other accounts also. So that doesn't really need a tag, but people who want to flourish as a professional who is in a salaried or employment in the industry, they probably need a bit of this, because when you will go out there and read more articles about the topic or probably even look for a job, you will find a lot of different things. Somebody will say, okay, this is a quant strategist, this is a quant analyst, this is a quant trader, okay, this is a quant front desk quant. So there are a lot of these names which are given. Primarily, in any quant firm, everybody does work as a team. They do have specific roles pertaining to their strengths, etc. And the segment of the market they're looking in case of big quant firms, there will be segments also. So in case of high frequency trading, yes, there is a very heavy duty work which is required behind the system, behind the engineering and the architecture of the system, because high frequency trading is a lot about speed. Okay, we'll come back to this discussion. So this is high frequency, right? This word high frequency. So even if somebody is a systems engineer and they want a role like that in quants, they don't want to make their own strategies or do too many things from that angle, that is also fine. Then you have quant strategists and quant research analysts who are trying to model, take new information, work on the existing models, etc. Okay, so there's this wide array of names which you'll see, but what is more important is to know the role behind, and before knowing the role, it is important to learn what you require to take up some role, right? So there could be a wide number of names. Some of them are interchangeable, like you could say two different things, but they would mean the same. So don't get confused about it. That's what I mean to say. Second is medium frequency trading. Okay, so medium frequency trading would range anywhere within intraday to a couple of days or few days. And there will be low frequency trading, which would be a little more long term. Be swing trades going on for a couple of weeks also. It could go on for months also. Okay, so low frequency trading is there, and low frequency trading could also have be a part of investment models. Okay, so low frequency means, obviously, as the name suggests, where the decision or the trade signal which we get is the low number of trade signals we get, low number of trades. In high frequency trading, there are like a lot of trades. Like within the first minute of the market, you could have like thousands of orders given out. That is how it could work, right? So this was a bit about the basic idea. Now let's understand the process. So we have raw data. Okay, then we use our edge to model the data, right? And then we backtest and then we execute. This much is clear, right? This much is clear. This entire process is clear, right? I have raw data. There could be a lot of data sources which we will discuss. Then we'll discuss a little bit about the modeling and give you some example also, right? Then backtesting is done. Okay. And then there's execution. This is a basic idea. Right? But actually it is not like this. That was a basic idea. So this is the entire idea. Okay. So I'm so sorry. Yeah, sorry, sir. Yeah. You can see the screen, right? So this is the entire idea. So first is research. Rigorous research needs to be done. Why does research need to be done? Because whatever you code needs to make sense, right? You can't just say, I saw that, or I heard that, or I read that in a book, and probably because a lot of strategies which are given out in the books, or if you could probably search YouTube and things like that, for strategies and expect somebody to give out something valuable for free, of that degree of value for free, then please don't think that is possible. You need to do your own research. Yes, you could build on others' ideas. You could amalgamate something with your own ideas, right? And a lot of sense is what it needs to make. Because there are a lot of biases which one tends to create while they're thinking, okay? So that part will all be, because if you do rigorous research here, it makes sense, then your backtesting process will be less painful. So in my case, in my initial days, I thought that whenever from research, it went to coding. So earlier, I never coded myself. That time, I did not know how to code. This back in 2018, 19. Okay. So somebody else coded it. And when I got the backtest result, I was highly disappointed. Okay. How many of you over here have ever tried to code a strategy or maybe a scanner through somebody else or on your own? Just give me a raise of hand. Anybody? Okay. Okay. Manish and Sachin. Great. So we've tried to code something, right? So that's good. Nothing wrong with it. And obviously, I'm not getting into the details. Some of them may be successful models. Some of them may be still in the process of making. Some of them may be completely ruled out. So in my case, most of them were completely ruled out in the beginning. But I did understand my mistake. And if I got too aggressive over here, it would be a very disappointing back testing thing, right? Result. And okay, so Sarvesh is saying he did it in Excel and faced the same thing. Yeah, Excel is a good place to start with. Excel is a good place to start with. So even besides the fact that I was learning how to code, I also started the first few things with Excel, right? So first is to research, then comes the coding part, then comes the backtesting part. Now, please understand, we want to make everything as real life as possible, as real life-like as possible. Okay. So when painters do painting, the painting has a lot of value. If the painting looks like a real life paint, real life, as if it's come to life. If I make a sketch of yours or a portrait painting of yours, it should look like, okay, the glow on your face and the smile is coming out very, very perfectly like real life. Just like that, we need to have as real as possible results. So we'll take some margin of error when it comes to losses which could happen due to slippages. Okay. Even that is also taken into account while doing the back testing properly. So kacha pakka back testing doesn't work. Proper back testing will work. No matter what, the first few times you are bound to be dissatisfied, almost bound to be. I'm not trying to discourage anyone, but you need a lot of practice. Everybody needs a lot of practice. So I was consistently getting poor backtested results for some time. And then I realized what my problem was. So I needed some concern needed to be chalked out. Okay. First concern needs to be chalked out is, does it make sense if I'm looking at this particular stock or this set of stock or this index? What basis should I categorize the instruments of which I've got data? Okay. One thing doesn't fit all. I learned it the hard way. Then, what are the parameters which I need to use? And are they working specifically only on this for a small period of time? Just because I saw last, say, 5 months chart of Nifty, and I tried to plot some things on the chart, some indicators. I said, okay, fine. If I buy when these conditions are met, this works out so well. And I want to automate it. But that doesn't work in different other phases of the market and gives me atrocious results. So it needs to make sense so that applied to different phases, it still keeps working. Okay. So how can I, maybe it works on a certain chunk of a phase of market. How can I filter out that data? How can I put more conditions and more variables so I could come to a better model? Then you come to coding the model. Okay, there are a lot of other deeper research considerations also. I'm not getting into each and everything very deeply. Okay, so then we come to coding. Now, obviously, how do I make coding as clear as possible? As whatever I'm thinking, if I can code that. Now, it's not that always that easy. Simple things are pretty easy. But then what happens? Some people tend to, get some bugs. There are sometimes syntax errors also. Very simple, stupid syntax errors could take a lot of time at times. But nonetheless, once you are used to it, then it gets pretty smooth. So it could be frustrating in the beginning if you're trying something new. Say, for example, there's a momentum strategy or I'm a trend following strategy. So I know a couple of things which would fit any kind of momentum strategy, and those codes are something I'm used to. Or even in case of Excel, as Arvesh mentioned, in Excel you are using some if loops, etc. You're used to these things. So that part will get smooth over time. But then there would be something which is new and which is necessary so that your strategy stands out and really makes the difference and gets the edge of computed. So for that, you need to spend some time, look at various approaches. Okay. Now, what do I mean by coding approaches? People who have tried some coding have some basic idea. No. For the people who are very new to coding, who have no idea of how programs work, it's okay. When I say approaches, it's like if I give you A, B, and C, I say A plus B is equal to C. I'm going to find C. Okay, so we'll probably do A plus B is equal to C, and we've got A and B data, right? But if you don't have something, then you have to derive something, right? So for all that, error is there. Okay, Mr. Shivam Kumar Shah is saying, for me, runtime error is a way more worse than compile time error. Okay. So there are multiple types of errors are there, which could happen, but not a problem. This is how the process is. Okay. Now, once we've coded it, we run through the code. We run it through our data, and this data needs to be cleaned. So cleaning the data is also part of the, as I said, the research and the coding process. So you got neat and clean data, run through the code of the model, and you get back-tested results. So how could the back-tested results be, right? Number one, the back-tested results have parameters which we need to look at. Say, for example, I have equity curve or the profitability curve of a strategy, which is very, very volatile. But at the end of 4 years, at the end of 2 years, at the end of 6 months, it is giving me some net profits. Is it likable? No, because I don't want so much volatility. So something called a Sharpe ratio is used, which is takes in both the returns, average returns, as well as the standard deviation is in. So try to find the risk-adjusted returns. Say, for example, there's a parameter called the drawdown period. So, for example, your strategy began and generated profits. First month, think simple numbers. First month, it was 1 lakh rupees. Second month, it was a loss of 20,000 rupees. Third month, it gave a profit of 1.2 lakh rupees. It was pretty stable, nice curve. But then there is a drawdown period. For 3 months consistently, it lost 20,000 rupees. 3 months consistently. Now, in the fourth one, it made up the losses. In the middle of the fourth month, it made up the losses. So your drawdown period is 3.5 months. There's something called a drawdown period. If a strategy has a very long drawdown period, that means if I backtest it and in the last 5 years, I saw there was a big cut and it took a long time to revert back, then that strategy is not likable. Okay, so likability of the strategy, because somebody will be putting in money, you will be putting in money. I'm not going to wait for 6 years or 2 years or 3 months. A very, very long duration. Also depends if I'm using a intraday trading strategy. I don't expect very large drawdown periods. If I'm trading something which is a LFT or low frequency trade, then I can say, okay, fine, the market condition or the market phase is such that there will be a drawdown period of 1.5 months. That justifies it, right? So the various parameters which you will get after back testing. Then comes optimization. If those parameters are not likable, how can I tweak my code? Now, this is very interesting. How can I tweak my code, right? I'll read your message in a bit, and I can see there's a long message. So I think what I'm saying will make sense to you. It's a personal message. Yeah, I'll get back to it. So how do I tweak my code? Now, maybe I don't know how to tweak my, because the initial idea and the edge which I had formulated, that edge was very specific. And I have that, like, I don't want to tweak my code, but I want to try and test also, because I want the thing to give me good backtest results. The model needs to be valid, right? Good enough for me to, or anybody to put money in. So the basic idea is that in today's world, programming, and which also the computing part also encompasses machine learning, even that helps you to do optimization. Okay, so there are models which could be used for optimization of your variables. Okay, then you come to the part where you see what is the optimum capital to be put. What is the optimum capital to be put in this? Okay, for the optimum capital part, I'll just quickly take you to another slide, because later I'll not be able to give you that. Okay, I can't find another slide. Okay, I'll come back to you later. Anyway, so what is the optimum capital which I need to put is the question, right? So once that optimum capital question is also answered, and everything is laid out, and a good backtest result, some bit of paper trading, either with a very small amount of fund, considerably small amount of fund, or you just need to see how the trading signals are working, if the system is working well. I'm not getting too technical, so I'm not getting into the system part. As we'll discuss a little bit about it, but I'm not getting into the system part, right? So how it is working, how it is integrated with the broker, and all the data which you're getting, live data, how the entire process is happening. So for that, paper trading is there, and then finally live trading with the desired amount of capital you want to invest with. So this entire process is hard work. It doesn't come for free. I mean, it looks pretty easy when we're talking about these things, what algorithmic trading is, etc. But no, doesn't happen that easily. So you need to give that time to it. I need to acquire those skills, learn a lot, and keep learning. Even after that, like, a lot of learning is involved. After that, you keep learning. Okay. So everybody clear till this point? Okay. Division, stick around towards the end. I will clarify on you this, right? Perfect. Everybody, okay. So I hope, like, yeah, for a lot of people, this is all very new. Those people who already are acquainted with the topic, for them, it could be a revision. I'm trying to, broadly take in a lot of things in this webinar so that you get a nice picture of what is there. Okay. Now let's look at the data sources. So basically, there would be paid data sources as well as free data sources available. So Yahoo Finance is a free data source. You can get the daily open, high, low, close data of a lot of ETFs, stocks, etc. All different kinds of instruments, right? Quandle is there. Okay, Polygon. I misspelled this. I'm so sorry. Okay. Also, there are paid data sources, obviously, to get a little more reliable data. Paid data sources are there, right? So Bloomberg, for example, one of the paid data sources. So this way, there are sources through which you could get a lot of data. Now, broadly speaking, what are the strategies which are there? Okay. Then we're going to get more detailed into the HFT strategies a bit later. I think just after a few slides. So trend following is something which is normal to hear when you are in the markets and trading. What is trend following? A strategy that has parameters around which they identify a trend, they enter the trend, follow the trend, and exit if there is a exit signal, right? Whatever the conditions are. There could be some time exit signal, there could be some price target signals, there could be stop losses also, right? So all these different case scenarios are there. That's how trend following strategy works. And there is a mean reversion strategy. A mean reversion strategy for the people who are more into technical analysis, generally they tend to think this is about the price. Sort of you go against the trend and you, like for example, in a upward stock, when the stock trend is upward, you're selling somewhere, and or you're selling when there's a reversion happening. Okay, when you're expecting it to come back to a certain point, right? Or when the stock is falling, you buy something which is falling, so because you're expecting a sharp pullback. So all this, what I said, is subjective, that needs to be quantified, ideas need to be met. Now there's another thing about mean reversion. So say for example, that there is an instrument or there is a co-integration between certain instruments such that when bought and sold, the spread is mean reverting. Okay. So that could be mean reverting when we are talking about arbitrage. Okay. So we'll come to those examples. Lastly, arbitrage is that. So a lot of the HFT firms do a lot of calculation and modeling around asset pricing. Now, when we discuss HFT, I'm going to get very deep into understand, giving you different types of arbitrage examples, asset pricing examples, right? So this is how it is. Everybody clear till now? If you have any questions, please ask. If you have any questions, please ask. Okay, so what are the advantages? We've gone through this, just quickly skimming through. Eradicates human emotions completely. A thorough backtesting will help you validate the strategy over a period of time. So absolutely, the validation through backtesting is a big strength, right? Third is trading multiple markets. You can probably, not just in your sleep, but in other time zones, in other countries and other markets and other types of instruments. You could trade because you have tested the system so well, and you could, just monitor it without doing too much, right? So that is that. Okay. Just a second. Yeah. So 1 second, I'm sharing the screen again. Okay. So particularly high frequency trading is, gained a lot of name and fame. So a lot of IT background people have got employment in that industry also. And what is HFT? What are HFTs? What is high frequency trading? As a layman, if I have to tell you, if you go to the stock market, if the market is opened at a certain level, SGX Nifty is at a certain level, our market is opening at a certain level, right? All these things are there. Now, as soon as the market opens, if you see the stocks and the indexes, etc., there will be very quick movements, fast movements which are happening. An index is a weighted average. In case of Nifty 50, it's a weighted average of 50 stocks. There's a calculation behind what the index is and what the index futures is and what the SGX is. There are arbitrage opportunities even there. And because of HFT, you have got so much liquidity because these high frequency traders, if there's any arbitrage opportunity of this called index arbitrage, they will quickly come in, grab that opportunity, and the bid and the asks, right? The bid ask spread will have depth. There will be some density of buyers and sellers, which is called liquidity, a higher liquidity in the market. So not only they create liquidity, this kind of strategy makes the market more liquid for people like you and me. They're not just doing that for, they're doing it for themselves, of course, but the liquidity also provides us with the benefit. Because when we want to take a trade, I want to sell the market the moment it opens. I have got a buyer, right? Because of that liquidity. So this is just one of the strategies I said. There could be something for option pricing, right? Quickly, all the options are priced correctly within a few minutes because there is no scope left. Okay. Yeah, I was using that word only. There is no scope left. So this is called market making strategies and liquidity providing strategies. So I'll come to those things. There's another slide for that. So very high speed is one of the features. This is what high frequency is, where very high speed, very high investment on the infrastructure. So be able to do that, latency needs to be next to zero. Like for every few seconds or millisecond, nanosecond also, there is a fight between HFT players. Okay, so high speed, and because there is a lot of speed involved, you need a lot of computing power, good infrastructure. Right? There's a lot of discussion we could have on co-location and all. Right? I'm not getting that deep. Next is low profit per trade. So as I said, you could have like thousands of orders the moment market opens by a firm, maybe even tens of thousands of orders, right? And every trade will be having very low profit. So the way HFT firms sustain themselves is because in many cases they get lower rates from the exchange. They get some kickbacks, you could say, from the exchange. They get some benefit from the exchange. So for them, the cost becomes very, very low. So even if they're getting a few paise on a stock and not getting a few percentage, like a regular trader would want, okay, I want 2-3% intraday on a stock, I'll call it a good trade. I want 10% on a stock over a week, I'll call it a good trade. But for HFT, the profit per trade is very, very low. And there is a large number of trades. So that justifies the capital invested, the capital of the portfolio invested, because large number of trades are there. Their capital does not stand. Probably in many HFT firms, is like they will square off the trade either in a few seconds. And even if those trades, even if they have some trades which are like MFT trades, intraday trades, they'll square it off before the market closes, regardless of profit or loss. They have such models also, right? So this tends to happen. So let's come to the types of strategies. Now, when I'm talking about strategies, here some of them could be used other than HFT also, but most of them are examples of HFT strategies. Right. So one question Kunalji is asking, can we outsource coding? Yes, you can outsource the coding part, but then you have to know that the person who is coding knows how to deal with this. So that part you could obviously check out before you could outsource the coding part, right? Yeah. So Karan said market makers. So here the market making strategies. A market maker historically, before computers revolutionized the trading world, if you have seen the recent Netflix, some of you have seen that recent Netflix 5-episode documentary on Madoff. So he used to run a market making firm. It's pretty good they made up. If you haven't seen it, it's highly recommended. So yeah, so a market making firm back in Wall Street, as Bernie Madoff had, what a market making firm does is they take both the buy side as well as the sell side orders, right? So there are a lot of liquidity providing and market making firms who tend to do that. And it is also there in OTC markets. And they are, profiting from a very small spread between the buyer and seller. So in modern day, the market making strategies which are run by HFT firms, it genuinely means that HFT is putting itself on the bid side as well as the sell side, bid and offer side, both sides. And it doesn't have to be all the time that like they are on both the sides, right? There would be stop losses also. There would be losses also in many of the trades. But what it does is sometimes they have strategies which would say, okay, fine, if there is an increase in the volume of the stock, increase in the volume, and this is the direction, and this is the strategy. Say, for example, they use VWAP, then they will start buying, being on the buy side, so that there's a higher probability of getting a price jump to sell. Now, this is a very layman explanation. To be able to actually calculate and properly automate and model this, there would be a lot of considerations behind the model, and a lot of that is where stochastic calculus, etc., comes in. Because assuming that when we're talking about small ticks, no technical analyst or fundamental analyst in the world can acknowledge that you can predict the markets. So they are taken to be random, and Brownian motion and such models are used to be able to understand asset pricing in that tick by tick short term, right? Ultra short term strategies. Okay, so market making strategies, broadly speaking. Next is acting on news. So, for example, as I said, give an example of web scrapping. There would be a news suddenly out there, and there would be robots which would be trained to make sense of the news, what it means, and what is there a very intense impact of the news? Say, for example, a famously known day when Nirmala Sitharaman came and cut down the taxes for corporates, there was a sudden rise in price. So obviously, there were a lot of bots out there because the impact of the news, even if you tell somebody who knows class 12 economics that boss, there is a lesser tax for big companies, you will that guy will probably say, oh, then probably the companies can grow at a very high rate, then they save a lot of cash. So very direct, high level implication. So when the market moved up suddenly, a lot of HFT trading was involved there too, right? And with the intensity of the news and the impact of the news, probably not just HFT, anybody is ready to buy at any rate. So they bid the price up very quickly. So that way, that was an example of a big and impactful news. Even there could be medium impact or small news also. And before humans can think and act, these trained bots, they think and act, right? Then there is statistical arbitrage. So again, this statistical arbitrage, one of them could be latency arbitrage, pair trading, right? So what is the probability of a certain stock? Latency arbitrage would be, say, for example, if there is a buying in Bajaj Finance, then there is a small bit of buying in Bajaj Financial Services also. So there is an opportunity. If this moves first, I could buy that and make a few ticks profit. But how do I backtest it? So I have to put in the required inputs. I have to see what is the probability of me getting the right trade versus the number of wrong trades, and all the backtesting, optimization, etc. And then you get statistical arbitrage, under which latency arbitrage, sorry, right? Likewise, there could be pair trading. We'll discuss pair trading in a bit, right? Index arbitrage. So index arbitrage, as I just explained, one of the examples of index arbitrage would be this, that Nifty futures has suddenly jumped. And if I were to go short on it and buy the rest of the stocks in the Nifty 50 basket, there would be an arbitrage opportunity. So that is what arbitrage would be considered. Index arbitrage would be considered. Okay. So these kind of things are there. Very interesting. Gave you some high frequency trading model examples. I hope it makes sense to all of you. If you have any questions, you can ask. Right? Okay, no questions. All good, right? Perfect. So we'll move on. Second. So then the next step is to understand the system very, very well. So as I was saying, data and algorithm, the computing part is one. And then you could have, a way to execute. So for example, if you've seen videos of by SMB Capital, one of the biggest prop trading firms in Wall Street, they have even their manual traders use a lot of algo. So for example, an algo is taking an entry, but they're making the decision on the exit. So even that kind of stuff is there, out there, right? So you need to know how the system architecture behind the entire process is, and the algorithm will connect to the broker and continuously get live data. And this live data will be all kinds of data, including, as I said, even sentiment data could be there. There could be news flashes, of course, price data, right? So there is no dearth of how big this can get or how detailed this can get, right? So first of all, your strategy should make sense. And I will show you some Python coding example. Here we'll take a momentum strategy example. So a basic momentum strategy, especially for the purpose of learning, a lot of people use is moving averages. Okay. So we'll come to that. Before that, I'll just quickly tell you about the Python packages and the sources available, right? So we'll come to that example. Now, let's say, how do I say that so we're going to go on for another 10 to 15 minutes. So just stay with me, right? Now let's take a look at this. Say, for example, what is the goal of my strategy? Now, mostly people will say, sir, strategy का तो goal एक ही है, profit. हमारे धंधे में तो सिर्फ profit है और क्या है, यही तो goal है, right? I'll give an example in Python, Mr. Azam, right? I said, so that's for the example I said. You can use R, you can use even Java or C++, whatever you like. I'm giving you some examples of the packages which are available in Python. Okay, so I'll come to that. So I hope I'm clear. Now, what is my goal? Let's understand. Goal, profit, definitely it is to profit, but it may not be the case. It may not be the case. Exactly. As Karan said, it is to beat the benchmark. Now, what is a benchmark? A benchmark would be something which is relevant. Okay. A relevant parameter to judge performance. So, for example, I say, I'm going to buy Nifty. I'm not going to buy it for intraday. I'm going to buy it for long term. But I'm going to buy it only when it is doing this. Okay. When I say this, you can just imagine some technical analysis parameter there. Say it's above 200 period moving average. Okay. And as long as it sustains above 200 period moving average, I'm long on Nifty. So I'll see the number of profits and number of losses. I'll see the size of profits, size of losses, average profits, average losses. I'll look at the equity curve. Now, because I'm specifically making it a buy and hold strategy with some parameters, right? It's not like completely buy and hold, but when the trade signal comes, it's buy and hold. It's a low frequency strategy. My valid benchmark can be a buy and hold on Nifty. If I don't do all that and don't model and don't backtest and don't put my head into all this, I simply go and buy the Nifty 50 stock in that proportion and weightage. Will that make me more money? So I look at the curve of Nifty, I will look at the chart of Nifty and look at the chart of profitability of my strategy. It may be so that Nifty is giving me minus 10% returns for this year. But if my strategy is giving only minus 2% return, I have been able to beat the benchmark. It could be that Nifty is giving a year-on-year return of say 21%. And my strategy is giving me a year-on-year return of 25%. I have beat the benchmark. So likewise, this extra above and over and above the benchmark returns is called alpha. And all the fund managers out there, all the financial institutes out there, they are seeking alpha. Everybody is seeking alpha, right? So this is something which you need to know. And the validity of the benchmark is extremely important. The benchmark should be valid because there should be some relationship between what you're taking as a benchmark and what your strategy is about. Okay. So that is how you will figure out if your edge is worth it or not after your back testing. So it necessarily, so the message over here of this slide is that necessarily our goal is not profit. Our goal is to understand things in a better way and understand what outperformance looks like, even though if there's a net loss at the end of the year. Okay. So let me just quickly look at if I missed out on this slide. Okay. Now, allow me to stop sharing the screen so I can share my Python notebook. Give me one moment. Almost done. So when it comes to coding, is now giving the example of Python, there are packages used. When I say package, what do I mean? Packages are or libraries are used. Where did it go? Yeah, are used to be, and there the new packages coming up every now and then to make the coding work more efficient, even in case of visualization, to make the visualization more efficient, more interactive, more meaningful. Okay. So these are just names of certain libraries. I'll give you a basic idea. A lot of talk around NumPy and pandas is there. So when I do normal coding, I can take a list of data, a list of prices, and I can do a lot of things with it. I could take an array of prices. These are the different data types. But pandas helps me with a data type called data frame. A data frame object is very helpful for me to arrange the data and to work with the data which comes in a tabular format. So in case of open, high, low, close or HLC data, there's a very clear tabular format in which, so my coding work around trying to arrange the data and relating the open to the close and the high to the open, etc., that is taken out of the picture and my work becomes very efficient. Oh, absolutely. Yeah. Data science. Absolutely. Data science and data cleaning. Python is used. Absolutely. Pandas are used. So pandas is very popular for that reason. And yes, again, a lot of things which we're going to talk about when it comes to libraries all the way to what are the methods of machine learning backtesting. A lot of these are intercept with data science. So it's a very broad subject that way, right? So NumPy, pandas, etc. are again packages helpful for computation, a lot of calculation. NumPy was originally made to do a lot of numerical work on Python. Now, pandas, for example, the data frame object, right? We are coding it in the hood of Python, but it has the efficiency and the speed because it is like made coded on itself on C++. Okay. Likewise, for example, matplotlib, which I will show you, is being used in my example, is for data visualization. So is Seaborn, or if you've heard of Tableau, all these are for data visualization. Okay. So I'll just get to the example quickly. Yeah. Share screen. Okay. So this is a Jupyter Notebook environment in which you can see I have imported certain packages. For those who are completely new to the coding part, it's okay if you don't understand a few things here and there, but try and make some sense. Whenever I'm coding something, I have to import packages and libraries which are going to be pertinent for me over there. And PD or Panda, the alias I use is PD for pandas. The alias I use is NM for NumPy. Okay, NumPy or NumPy. For matplotlib.pyplot, the alias I use is PLT. So what I basically do over here, in case I'm not using my Yahoo Finance over here, it's just the thing is you put over here the import, it has been imported away, but I'm not using it. I'm reading a CSV file which is stored on my computer, and the name of the CSV file is Nifty. And this Nifty CSV file has got more than 10 years of open, high, low, close daily data. Okay, so there are a lot of data sources, as I told you. This particularly I got from Kaggle. Okay, you can get the same thing from Yahoo Finance as well, right? So what I did was named it as DF, and this pd.data frame is the required syntax to import the CSV format data and get it into a data frame object. So this is the data frame, how it looks like, right? Open, high, low, close. And when I did this, so there are these subtleties for those who are new with coding. Index column is equal to 0. So generally this would have an index column. Instead, there is no index column, so it takes the date as the index. So whenever it makes me very easy, it makes it very easy for me to plot the graph. Date is taken as an index, right? Here I did to reverse the order since it was showing from 2022 and back. Okay. This is only the close column. So when I got the date and the close column, it will show the index columns. That is why it's showing the date. I don't have to call the date separately, and it is giving me the close column. Okay. Now, why I'm using the close, I took the close column separately to show you number one. Secondly, I'm going to be using moving average crossovers. So I will be plotting the moving average on the basis of close, right? Now, just selected a certain row and column range just to show you over here. This is how you select a row and column range. I have plotted in a very simple way, not using too much syntax. Okay, plotted the close, from 2000 it's like, okay, so this is in reverse order. Sorry. Yes, I have plotted the close basically from 2021 to 2022 around September. Why? Because I've only taken a range of 300 days over here. If I want to, I can take a long-term picture also. Okay. Now, this is the 20-period moving average. This is the syntax for moving average. So I created a new data frame, new column over here called 20 MA. And how did I get this 20 MA? By calculating it through the formula, right? So that is where it becomes very useful to use NumPy and pandas, and get a separately new column in that. So this is like a 20 moving average. To give you another example, over here in another notebook I'm showing. So all this process I've gone through the same. So over here we have got 9 moving average and 21 moving average. Even though these both are close to each other, I'm not trying to share any foolproof strategy. It's just an example. So please take it as an example, right? So I have plotted the entire, not the entire, again, 300 days period. Okay. So you can see there's a 21 moving average, 9 moving average, etc. And they are, as you could see on a chart. Now I'm using matplotlib to be able to plot all this chart. But just in case anybody is wanting something more interactive, they could try out different packages, which will make the plotting more interactive, right? So this is a certain section, like a certain section of the chart, the recent, section of the chart, which is showing me only the 9 moving average and the 21 moving average. And quickly coming to the computation part. So I, went through certain computation and tried to, so I went through certain things. As I'm saying, like I went through the data basically, and whenever there is a cross happening, whenever the 9 moving average is greater than the 21 moving average, I'll allow it to give me the signal 1, and otherwise it will be 0. So this NM where, NM is short for numpy, right? So NM where is the syntax used to find out wherever this is happening, right? Wherever this is happening, right? So can you please share the public link for this Jupyter IPNB? Okay, so since this is not like a complete project over here, so it will not give you so much value if I share it, but if you want, I'll share it. Alternatively, some of these are there on my LinkedIn. But yeah, if alternatively, I can share it. Not to worry. Okay. So this will create a signal column, and then they'll create a return column. Okay. Later, system return is also there. So when it creates a return column, it will show me what the returns are. So I can separately plot the return. But here, what I've done for you all, just to give you an idea. So we can do a lot of play around a lot with the visualization part. And in this case, I have created an arrow which goes down or an arrow which goes up whenever certain conditions are met. And even though you can see a lot of arrows, it's so dense that you probably can't see price also so properly. But if I zoom into this, or if I use some broader moving averages, it would have looked much cleaner. Okay. So this was an example of how I start with the basic coding and visualization using moving averages on Python. Okay. People can try this out in the beginning in Excel also if they are comfortable. The similar aspects are used. Okay. So this is the thing. Now, what I used over here was a neat and clean daily chart data. So it's not like it's so difficult to clean, or it's something like a very big problem. But when you've got data which is like a lot in size, then sometimes you have like null values, etc. So you need to clean the data and consider those things. One last example I'll give you before finishing this and give you a nice conclusion, solving any questions if you have. Last example, and 1 second. Yeah. So let's take, for example, what is pair trading? Now, a lot of HFTs and MFTs also use pair trading strategies. From a layman perspective, if I have to share with you, okay, a complete layman perspective, I'm saying this is a market, right? Just a second. Yeah, this 1 second. Okay, so these are two markets. Okay, one is the S&P 500, the other is Russell 2000, right? Both of them have a futures derivatives market also, right? So if I see that on an overall basis, they tend to move together. Now these together obviously will say, sir, in दोनों का तो price अलग है. But through co-integration, first we understand what is how these markets are correlated. And then we focus on the core integration model. And then we come to a point where we are able to actually see, and when we do that, when we see how the spread between, say for example, Russell minus S&P 500 would move like this. So it would move around a certain mean. So whenever it goes to this extreme, I sell the spread, and whenever this goes to this extreme, I buy the spread. Okay, like it will always revert to the mean and most likely to the opposite direction as well. So over here, for example, when we see a fall happening, this market and this market, both of them fell, and one fell more than the other. Okay, suppose I start my strategy now. So when I see that significant difference, when the lower end of the spread is touched, I will go long on the spread. And you can see that by now, the spread has actually come together, right? So the spread is almost zero, right? So you get a significant profit from that. Now it's not as easy as said, because in some cases, statistical arbitrage, specifically speaking, this kind of mean revision strategy, this kind of pair trading strategy, the profit, the holding period could be months, and there could be a heavy capital investment behind it. So this is the thing, right? Before we go, just 1 second. I don't know what happened with just allow me 2 minutes. Yeah. Okay, if you have any questions, you can ask at the moment. If you have any questions, please ask. Any questions? Or no questions? Okay, a little bit about me before we go. So my name is Mohit Pajicha. I've been as a financial market professional for a very long time, about 11 years plus. And it's been a long journey. I've worked as an investment research analyst. I've worked as a trading coach. I've done two levels of the CFA program, and I've completed my CMT program, all levels. I've also, done a lot of research and learning in quantitative finance. Overall, it's been a long time. And if you want to visit my website and find out about the courses which I have, then you could go to technicallysorted.com. That is the banner name of my teaching business, coaching business. And this is the number you could connect with me on. This is the official number of Technically Sorted. So you can just drop a message. Okay, so we could connect on that. Okay, Siddhant is asking, Mohak, before you go, I wanted to ask, if you were to start from scratch in quant finance, what would be the best roadmap you would take? Very nice question, Siddhant. Very, very nice question. Okay. So if I have to start from scratch, or if I have to suggest somebody who's starting completely from scratch, the first thing I would ask them is, how much interest do they have in financial markets? When I say financial markets, like everything, a lot of things, okay, in this field. Then if they have enough interest, they have a basic idea of the stock market, etc., then I would definitely ask them to learn basic fundamental analysis and technical analysis and econometrics, and side by side learn coding. Okay, so that is where I would say. So it's like multiple subjects. When you go to suppose you're a science student and you're studying maths, physics, chemistry, and etc. So you pay some hours of the day, you pay attention equally to these subjects. So I would ask him or her to learn these things, and definitely that would mean that if somebody is starting from scratch, if they are very young and have a lot of time in their hand, then they could learn multiple languages when it comes to coding. Learn from a lot of books. There are some interesting books on quant finance. One of them I could recommend. It's on my desk only, by Dr. Ernst P. Chan, right, on algorithmic trading. Then there are books which are out there. So there's this one book on this thick book on market microstructure. So there's just 600 pages of market microstructure. And there's a lot of ebooks and this, that, you've got a lot of sources. So there is no end to how much you can learn. So if somebody's starting from scratch after the basics, I would say dive into this, start learning. There are a lot of articles. There's something called Quantpedia website, again, completely open source. So people who want to gain more knowledge and see valid strategies and how people share their logics, Quantpedia is a very good place to explore. There are other blogs also, for example, Seeking Alpha, right? So this would be the general roadmap I would ask them to take. Then it would be, if you're asking for formalized courses. So there are formalized courses out there for coding, basic coding, for financial mathematics or financial engineering. Okay, so a young chap comes to me and say, okay, go do a small course or a very nice master's in financial engineering. That would be another way of going about it too. Okay. Then of course the coding is inevitable. That will also have to go on. So that is how it is. There's like unlimited learning, and there could be one person who's very accomplished but hasn't read a lot of books, and there could be a person who's read a lot of books but isn't like ready to execute a lot of significant things. So it's about whatever you do that with clarity. Take time. You can go slow also, no problem. Take your sweet time. But when you do things with clarity keeps increasing at an increasing rate. That's what I can say. And I hope my answer is pretty nice, loud and clear. So this is the general pathway. Financial engineering, financial mathematics, and coding would be the formal learning. Yeah. So a lot of people ask me, especially when I speak to different firms, and sometimes I'm speaking to the HR people. So they say that it's a good thing that I have a CFA with me. Don't have the CFA charters per se, but I've done CFA. So, you know, it depends. Like, for example, somebody, just excuse me, allow me to grab a sip of water. So for example, if somebody has got any kind of background, right? Yeah, CQF is also there. And then there is a Master in Financial Engineering you could do from a place called Quant World, which is completely online, right? So things like, say, for example, CFA or having an MBA finance, all that definitely helps because the domain knowledge increases. And today, one person, you can't expect him or her to know everything about everything. Sit in front of the television, watch all the news, observe all the business news through newspaper, see the live markets, know a lot about coding, be able to give so much time to be able to arrange data and code, etc., etc., etc. So you have to choose your battles and go step by step, right? Anyone else? Any other question? Yeah. Is it true that only the top engineering students or PhDs get hired in HFT or hedge funds? Well, yes, there is a notion around or a bias around top engineering students and PhDs. Why the justification given behind that is number one, that they can handle the level of maths which is required, and they can do all the coding which is required. The reality is that there is a lot of system architecture work, as I said, in HFTs. So the big engineering institutes, they have, because that is a primary need, right? Good coding experience and good ripe coding knowledge. But then if you work hard, gain the skill, even if you don't come from an engineering background, there are people who, without a PhD or a formal engineering background, they get into, they start maybe not from HFT, but they get into HFT. So you have to know what you want. That is there, but and this bias is there a little bit. It is there. But if you graduate yourself, somebody starts with MFT strategies, and they learn a lot, and they learn the required learning which is there, and they can provide the solution to the problem. Then their experience counts more than their degree. Am I clear? And in the same way, if you are from a engineering background, and as somebody also personally messaged, he is from IIT Kanpur. I'm not saying the name because it was a personal message over here. So, so he's a software developer working with a big name. Okay. So probably there's certain edges which need to be, so certain rough edges which need to be taken care of. And there's certain new way and pathways of thinking and coding that need to be learned for him also, and for anybody to be able to specifically do things in this domain. Okay. They are chosen, what you were saying, a lot of HFT firms go directly and choose from the institutes, but you have to remember there are a lot of people in those institutes who don't pass interviews also. That is also a thing, right? There are a lot of people who are least interested in the stock market, and there will be some people, with due respect, who may not find it that interesting some years down the line. It just didn't interest them. They went in for the money. It could be that, right? So this is how it is. Okay. I've completed my CF and FR. I was planning to do CFU. We'll have to get there. Yeah, I think this, it will help. I think it will definitely help. And if you want to connect offline, because it's a very specific personal question, then probably we could chat at length about it personally. So we could connect offline. I'll give you much greater details in that case. Right. Anyone else? Thank you. So thank you overall. And we have overshot time, but I really hope, really hope that it was very insightful, especially for the people who are getting an idea about this for the first time. Yeah, absolutely. That's what I mean. You connect with me personally, most welcome. Sometime over the week, we can have a clear chat about things, right? Not to worry. That is the whole reason why I'm sharing my contact details. Okay, so you feel comfortable reaching out. So Kunalji, you have done the technically sorted course with me, you're a node student. Let's connect on the phone regarding this. If you want to try out a strategy, I can help you get the coding done. If you want to outsource the coding part, we can work on it. Right? Not to worry. Not necessarily that I'll be doing it. Probably I can also do it, or we can have, I can recommend you somebody you can outsource this to. Right. Gurdarshan Singh ji, thank you very much. Got to know a lot. A lot needs to be learned. Most welcome. Most welcome. It took me, it's not, the topic is so broad. I mean, what I told you may not be like the most advanced thing in the topic, but the topic is so broad. To put together the entire presentation was also quite a time-taking task for me. So I think with a lot of people sticking around till the end, the hard work is paid off. And I'm really glad that all of you had a good time. Okay. So thank you so much, and let's sign off now. I guess the questions are done. Thanks a lot, and see you around if those who are not out there on LinkedIn, I'm pretty active these days. So you can, just add me over there. My name is Mohak Pachisia. And we can connect offline also. Okay. So thank you. Take care. Yeah. Goodbye. Thanks a lot. Thank you so much. Thank you. Signing off.